All right, yield nerds, episode 106, and this is a combination of three separate topics. So I'm very excited to share what I learned this last week with you. And the ground is going to shift yet again in the Yield Super Bowl. Yes, we will be playing the Yield Super Bowl. And that is me right there in front of the New York Stock Exchange, just exercising my power in fixed income investing. We'll see more about that as well. Thank you for tuning in, and we are at 260 subscribers. Thank you for your support. And if you are joining right here in the middle, please make sure that you take the time to review our playlist called the Yield and Income Investing Roadmap, which kind of starts it from a beginner level and brings us here. Most importantly, remember, I am learning myself and I don't have any superpowers. Make sure you do your own research and come to your own conclusions. The agenda for this episode is in three parts. The first, we will play the Yield Super Bowl, and you're going to see some very interesting things. Well, at least it was interesting to me. Next, I'm going to introduce Growth Nerd, an interesting topic. And we will finish up with what I'm doing with my 3 month plan. And I'd love to hear your feedback. And if you want to share what you're doing, that would be great too. What is the Yield Nerd Yield Super Bowl up to? And something very, very interesting. I call this the TBill time machine. The orange curve is from 6 months ago, give or take. The blue curve is from about a year ago. Look at what happened. Yields rose uniformly from a year ago to about 3, 4 months ago, and time has rewound. It's almost the last 12 months never happened. And we are back to where we were a year ago. And that has certain implications. Implications such as a potential conclusion that inflation has been tamed and the market is no longer interested in fixed income. An implication that somehow all the forces have come under control, even with high employment and tremendous growth, pointing towards the equity market. That is what numbers are telling us. Whether you believe it or not is up to you, and I'll share what I think about it. So, with that as the background, let's look at the Yield Super Bowl. And for those of you who are not familiar with it, I would strongly recommend you watch some of the earlier episodes to understand the basic concepts. But we take the most prevalent fixed income instruments, treasuries, agency bonds, munis, and corporates, and we compare their yields across each duration. Not only that, because some of them are state tax exempt, and some of them are federal tax exempt, and some of them are not tax exempt at all, we kind of neutralize them by looking at the pre-tax yields. And I'm going through this very, very fast. I strongly encourage you to look at some of the previous episodes where we review the rationale for every one of these. And before I go any deeper, I need to forewarn you that I am not a wealth management advisor. I'm not giving you investment advice. I'm sharing what I learned. This lady here is getting snake oil. That may be me. Don't trust me. Do your own research. So, what did episode 84 from a handful of months ago, 5, 6 months ago, tell us? Well, it told us that treasuries ruled the roost before the 9 month time period, before the year time period, and then it was all agencies. So, it was treasuries and agencies, and that was the reality in August. We roll forward another 3 months and come to November. Strange things happened. That was an aha moment. Treasury still ruled the world until about 9 months. And then all of a sudden, a whole bunch of munis showed up. And look at these pre-tax yields. Insane! Almost 7% tax pre-tax yield, meaning if you had a 28% marginal tax, and you'd have to look at some of the previous episodes to understand that. But on a tax adjusted basis, treasuries were incredibly attractive in November, and they became the champion. And over a period of time, you saw some corporate bonds, again, bank bonds show up. And this was November. Are you ready to see what today brings? And it is going to be a surprise. It was for me. Look at this. Without any labels, the first thing that you can see here is some level of convergence, meaning things aren't going way up or way down in aggregate. And there is a concept in fixed income investing called term premium, meaning if I'm going to hold something longer, you need to make it better for me to do it. And just looking at this, things are kind of sort of flat. If I pick the best of available options for each duration, I'm still earning the same amount. And so I, as a fixed income investor, I'm going to say, why bother? Why am I going to hold something longer? And so treasuries are still ruling in the very, very short end. And what a surprise, bank CDs control the middle of the curve. The big news is agency bonds. That's the gray line right here. Agency bonds have crashed and burned in the middle of the yield curve. And towards the very end, bank bonds again, these are bonds for financial institutions, they take over, and agencies now are the lone star in the 5 year and greater duration. I thought that was very, very interesting. And it certainly educated me in what I was going to do, and I'll discuss that more. But before I get there, I need to kind of bring it all back to the Super Bowl theme. I couldn't invite Taylor Swift to the Yield Super Bowl, and our Travis Kelce here is a fireman, and he is inviting the growth nerd. And with my wife's permission, I am allowed to design a fictitious growth nerd who has a rocket attached to her backpack, and she is coming to the Yield Nerd Super Bowl. And the growth nerd and the yield nerd are going to start collaborating for the very simple reason, if you do not give me a term premium, meaning if you don't incent me to hold things for longer, to hell with fixed income. Well, not quite. But I certainly am not going to be loyal to fixed income if you don't give me a term premium. So I'm starting to set up my growth portfolio. And here is how I'm doing it. The very first thing I'm doing is selling some of my trusted, the goose that laid golden eggs, if you will, my value portfolio. I'm selling a couple of them, one OK and Williams, which made a great appreciation for me. Thank you for your service. And I am then going to, reallocate some short-term treasuries to start with a portfolio that still is value focused, but positions for growth. Let me explain more. So the first thing I did on the growth nerd portfolio is go back to my favorite infamous 4 filters. And instead of making them very hard and fast, meaning best in class, I kind of loosen the boundaries and say, well, instead of a debt to equity ratio of zero point 0.2, what happens if I increase it to 0.25? And instead of a cash flow per share of 15, maybe I start looking at companies with a cash flow per share of 12. And that's on one of the filters. On the second filter, the Magnificent 7 or now a Magnificent 13, again, because I'm tolerating a slightly lower profit margin, a slightly higher debt load, a slightly lower cash flow, and the value all stars, and these are all filters that I've covered in previous episodes, I again loosen the same boundaries. Cash flow, price to cash flow, debt to equity, return on investment capital. So if I'm willing to take a little bit of a haircut and say, okay, tell me what else is on the boundary, that is how I'm thinking about my growth portfolio. I'm not chasing stars. I may be chasing something. I will tell you more in a bit. And so here it is, my public growth portfolio. And I will be sharing this every week. And not only that, every one of these will meet the conditions in my 4 filters. Some of them I've held for a while. You can see I have Encore Wire, Mueller Industries, TK Tankers, which is a new one into the Magnificent 13, Calmain Foods, Chevron. I did pick up Archer Daniels Midland after their little crisis that came about. For those of you that are curious about Archer Daniels Midland and their history, there is a movie called The Informant. The Informant is a movie on HBO. I would suggest, I have no conflict of interest in saying this, I would suggest you watch that movie. It's very interesting. Pioneer, Pulte is a new entrant. Once I loosen the boundaries, Pulte shows up. Chesapeake Energy, Standex is also a new entrant. Again, when you loosen some of these boundaries, new companies show up. Dillard's has not yet published their earnings. They will in another couple of weeks. They show up as well. So as you can see, there are a few new players, Standex, Pulte, Dillard's, people like that. And I will tell you more about what the one equity here that I'm hiding as we proceed. So the point in all of this is I'm setting up my growth portfolio. At the moment, I'm up 5%, but these are the market is volatile, so I don't know how it is going to go, and I will start sharing them with you. So what is my 3-month plan based on what is going on? I firmly go back to the micro and macroeconomic setup. There is a lot of turmoil in the politics side. We have an election year. We don't appear to cooperate. There is a spending bill that is coming up, and I am not optimistic that there will be a spending bill. There are geopolitical risks. And so my boring portfolio is practically flat at the beginning of the year. For the last 6 months, I'm up about 2.8 something percent, nothing stunning. And so, where am I going with this? My humble opinion is that we will still live in nirvana for the next 6 weeks. Everybody will be talking about this soft landing and how amazing it is. And there is not going to be an interest rate cut. Chairman Powell has said as much in March. Whether it'll happen or not, we'll see in the future. Oil and gas is trending low, possibly is going to continue to trend low because of a lot of the read that China's economy is going to slow down, and I have my own theory on that. And as far as the spending bill, I'm not optimistic, so I do expect some turbulence towards the end of April. And so after a nice honeymoon ride for the next 5, 6 weeks, I do think between the spending bill, some level of interest rate cuts between now and the election in order to ease the pain. And who knows where the Middle East conflict is going, and some oil and gas price increases in the middle of summer. We're up for a very, very tricky next 6 months. And that makes me want to think about how do I want to position it. And, the yield version of Taylor Swift and Travis Kelce now are starting to meet each other more. And this is the backdrop that gives me the idea that I'm going to start looking at cumulative preferred stocks. And if that term does not immediately register, I would suggest you watch some of the older episodes on preferred stocks. Cumulative ones are those that owe you the dividend even if they miss it. And I don't buy ETFs, I buy individual cumulative preferreds. And in terms of equities, I already told you I'm going to be sharing my equity buys in public, but it is going to be my 4 filters with slightly bigger borderline stocks. And I am going for increasing of durations, except on callable bonds, and I'll explain that some more. So for fixed income, here is my strategy. I am going to do what is called the yield barbell. On the very short end, I am going to stick with T-bills and see what April 30th brings to us. On the long end, and in my world, long end is 3 to 5 years. And in that area, I'm sticking with callable agency bonds that pay 6% or more. And sorry, banks, I am not going to buy bank CDs. I'm not going to invest in corporate bonds that are issued by banks. That's just my strategy. And so I'm skipping the medium term. I'm going with the yield barbell. And one quick thing, and I am fallible, and I go chasing some kind of mirages as well. And I watched this movie called Dumb Money lately. If you have not, something for you to consider. It's a very entertaining movie, and it's about GameStop and how that came about. And I took a nice dinner for four, the equivalent of whatever I would spend on a nice dinner for four, and chased a certain speculative stock. I'm sharing my story. I am not recommending that you buy it or not buy it. I'm just telling you what I am doing after watching an entertaining movie. Well, remember I showed my portfolio and I had one particular equity blacked out. That was inspired by dumb money, and it is Plug Power. Well, a little bit about Plug Power. They have 600 million shares outstanding, 158 of them shorted. So almost 25% shorted, which is kind of stunning. And if you read more about it, you will see that there is a very high degree of variation in messaging. On the one hand, they talk about new plans and how they are shipping to new customers and they sign a new contract. And then on the other hand, they actually talk about running out of cash. So their particular equity increased by 35% last week. I do not have that. I did not own it at that time. Their CEO says, hey, Walmart and Amazon are our latest customers. We are shipping product. We're going to do well. We're going to surprise short sellers. One minor detail, we may run out of cash this year. And my read on it and my reasons for buying it are very simple. Usually when a company issues new stock, and I would pretty much go to bed knowing that Plug Power will be issuing new equity because they don't have a lot of cash. And if they don't have a lot of cash, they can't get loans given their financial condition. They probably will issue new cash. Usually, new stock will decrease the price of the stock because your price to earnings ratio will go down. Well, Plug Power doesn't have any earnings. And if your decision is whether the company will be alive or is it going to die, the way I believe the average investor will look at it, please make your own decision, is that if this company that is running out of oxygen suddenly gets a new influx of capital because they issued new stock, my guess is that their share price is going to go up and not down. And that is the reason why I bought Plug Power. Please make sure you make your own decision. Having said that, the episode is already a bit too long, so I want to kind of summarize my trades. On the barbell, am sticking with callable agency bonds at 5.5% or more, state tax deductible, so that's more like 6% yield overall. And then I'm sticking with the 3 months or less treasuries on the very short end. And my equities, especially the ones that meet the filter that I'm buying, are now going to be open book. So you will see what I'm buying. My 3 month strategy, therefore, is increasing duration via agencies, very short term on treasuries, and with the geopolitical risk, just using my slightly broader filter to start a growth portfolio. Thank you for listening to Yield Nerd. Have a wonderful weekend.